Welcome to TSAT. As part of our lecture series on Indian economy, we started with in money and banking. The first part of money and banking, we discussed about what is the definition of money, and then we have seen the functions of money, the evolution of money, okay, and then later we discussed about the measures of money supply, what is money multiplier. Later we discussed about the financial institutions, the definition of financial institutions and financial intermediaries. And then the difference between banks, non-banking finance companies, what are development financial institutions, okay, and then the insurance companies. We also discussed about various types of banks based upon the ownership and what's the difference between scheduled and non-scheduled bank, commercial bank, cooperative bank, regional bank, then payment bank, microfinancial institutions, and then small finance banks. So now let's continue with our discussion related to money and banking. Okay, let's start with various types of accounts. So we will not be going for exhaustive list of all different types of accounts, but we generally happen to categorize accounts based upon their liquidity. So the first and foremost account that I would start with is current account. Current account is mostly used by business people. Okay, so most of you might be aware of the fact when it comes to current account, the amount of you don't have any restriction with respect to the amount of money you could deposit or withdraw. And as such, the one thing you need to remember is, in general, there would not be any interest rate paid upon the amount of money that you maintain in the form of current account. But the feasibility or the advantage you would be getting is you don't have any restriction with respect to the amount of money that you could withdraw on your demand. Whereas the next common account, is saving account, because this is the first and foremost classification of accounts. Whenever you've been to any ATM machine, the first and foremost classification you will be coming across is current and savings account. So savings itself simply says, and how do you define a savings? Savings simply does mean postponing your spending. So if you postpone your spending, does mean that money is something you could spend it for the future. That's what we call a savings account. And within savings account, we do have these accounts. One is a demand deposit. The other is the term deposit. So this term deposit, what we generally refer as a time deposit or fixed deposit. So no matter whatever the terms we happen to use it, but in general, the savings account would be further classified as demand deposit or term deposits. So demand deposit, I would say demand deposit is simply a combination. It would have a features of both current and savings account. In a way, though demand deposit earns you certain amount of interest rate, that earns less than whatever the interest rate the term and fixed deposits pays. The difference between demand and term deposit is that term deposit is relatively illiquid than compared to demand deposit. The reason we have this term demand deposit does mean you have a right to withdraw your money upon demand, but there are restrictions, reasonable restrictions with respect to the amount of money you could withdraw from your demand deposit. Whereas when it comes to term deposit, you need to liquidate. So when I say term deposit, let's say you happen to deposit or make a fixed deposit of some 10 lakh rupees for 3 years. It doesn't necessarily mean that these 3 years happens to be a lock-in period and you cannot withdraw. The first and foremost thing, if you want to withdraw your money from a term deposit, is you need to liquidate into demand deposit, and it is from that demand deposit you could simply withdraw your money. So term deposit is something relatively, so since you are promising that your money would be for a while with the banker, so that's a very basic reason the banker would be willing to pay you a relatively better rate of interest when compared to demand deposit. So I guess now you would be able to make it out. If I ask you to arrange them in the descending order of liquidity or ascending order of liquidity, these 4 different types of accounts, I hope you would be able to do it. So liquidity has been the ease of converting an asset into any other commodity. So how easy you could convert any asset. Let's say if you've been given gold, money, isn't it, and land, and if you've been asked to transform all of these things, these 3 things into any code or any commodity or any service, then you know the fact that money is something that could be easily converted to any commodity, and that's the reason many times people happen to use this word called liquid cash. The reason why people use the term called liquid cash, because that is something easily converted into any asset, and you could simply exchange it for any commodity and any service. Whereas when it comes to land and gold, you need to liquidate into cash, and that's the cash that could be liquidated into any other commodity, and that's the very basic reason why people use the word called liquid cash. So if you've been asked to arrange these 4 different types of accounts on liquidity, I think you could be able to make it. Now let's go ahead with understand some other terms related to deposits. So as such, we have seen term deposit. Similarly, if you happen to keep your money on a lump sum amount of money, it's a fixed deposit. Similarly, you could also have a recurring fixed deposit, wherein on a monthly basis, you could make some fixed deposit, term deposit on a monthly basis, a certain amount of income, a certain amount of your savings on a regular basis. That's what we call a recurring deposit. Similarly, when it comes to NRIs, we do have different accounts which really happen to serve the purpose of your examination. That is NRE, NRO, and FCNR. So these are terms that we regularly come across when it comes to NRIs. Okay, these are three different types of broadly the bank accounts that banks, NRIs could operate in India. The first two different accounts, NRE and NRO, are the bank accounts operated by the NRIs within Indian banks. But these two are denominated in Indian currency, that is in rupees. Whereas the last one, FCNR, stand for foreign currency non-resident deposit. NRE stand for non-resident external. NRO stand for non-resident ordinary bank account. And these two bank accounts, though they could be, the deposit could be in foreign currency, but when it comes to maintenance of these accounts, or these accounts within Indian banks are denominated in only Indian rupees, whereas when it comes to FCNR, these accounts are denominated in foreign currencies like dollar, euro, pound. So these banks in India do allow NRIs to maintain bank accounts or operate their bank accounts denominated in foreign currencies. So on the different NRE and NRO, if the income source happens to within India, in general they are allowed to operate an NRO. If you have an income source outside India and you want the account to be denominated in rupee, you would be going for NRE. Whereas if you have your source of income from abroad and if you want to maintain your account in a foreign currency, then in general in such case you would be going for FCNR, foreign currency non-resident bank account. Similarly, if Indians, if a resident citizen of India is interested in opening a bank account in India denominated in foreign currency, then in such case people could go for resident foreign currency accounts. So these are certain important foreign bank account that people of India could operate, people and NRI could operate within Indian banks. As such, I already defined the difference between the commercial bank and a cooperative bank. Commercial banks are the banks that operate with purely profit motive, whereas cooperative banks are any other cooperative societies wherein they happen to pool their meager amount of money for the purpose, serving the purpose of those people who are part of the society, and their motive of operation is neither to make profit nor to make losses. But when it comes to term universal commercial banks simply doesn't mean that they have presence across the universe. Universal commercial banks are those particular institutions that provide large number of varieties of financial services. Like you could simply walk into that particular institution for the sake of having a demand deposit, term deposit, or you could buy an insurance policy. You could simply open a demat account. So all similar, the large number of categories of financial services, if they've been provided under a single roof, then in such case we do generally refer them as universal banks. Let me also make it clear with respect to the term core banking. So when it comes to core banking, core banking is a concept wherein if the banks happens to have a network wherein a person having one particular bank account in one branch could operate or could simply provide avail services with respect to his particular bank, with respect to his particular bank account from any other branch. If you have these bank branches interconnected and if you could avail the services of your banking services irrespective of wherever you happen to have your bank account in whatever the branch it could be, such kind of services provided by the banks is what we call as a core banking. That means a networking of all the bank branches which helps the banker, which helps the account holder to operate his account from any part of the country. Such kind of services provided is what we call as a core banking. And as such, one of the major recommendations of Narasimhan Committee is that, I think you would be aware of the fact of with respect to Narasimhan Committee 1 and Narasimhan Committee recommendations. The first Narasimhan Committee is for the sake of making certain suggestions with respect to liberalization. During the time of liberalization, the purpose is simply to make some recommendation for the sake of liberalization and improving the structure of financial system in this country. As part of it, Narasimhan has made certain recommendations in the 91-92, the first Narasimhan Committee. Later, with respect to reforms in banking sector, we have one more committee related to banking sector. That's by again headed by Narasimhan. So in one of the committee recommendations, one of the recommendations of this committee is simply to go ahead with PSB mergers, because we have large number of public sector banks, all of the banks owned by the government of India, and you have large amount of redundancy, isn't it? And that's the basic reason. One major suggestion he happens to make is simply go for merger, because rather than having n number of branches providing similar kind of services and you happen to have multiplicity of these branches in different parts of the country, result in huge amount of operation costs, maintenance expenditures, and henceforth, in order to reduce the expenditures of these public sector banks and try, he suggests to go for mergers of various banks. And here are certain list of mergers that has taken place in the recent past. I don't really expect you to buy out these things, but I think you would be able to appreciate the purpose of mergers. Though they might be resulting in some job losses, but at the end of the day, they would really help in saving a large amount of public money, because every time you have a bank present or bank present in a certain part of the area, you need the financial resources, and you need simply the human resources, and this all results in a duplicity of the resources. Okay, so that's a basic reason we happen to go for PSB mergers. And let's try to concentrate much more on problems related to banking sector, because this happens to constitute the major challenge for the banking sector. So one common problem related to banking sector is post liberalization we have a different problems, but prior to the liberalization, you know the fact that 1969, okay, after State Bank of India and Associates has been nationalized, then later around 14 banks have been nationalized in 69 and 80, okay, in 1986 more. So prior to 1990s, the banking sector has been largely dominated by Government of India. There are hardly any private banks present, and there is literally zero number of foreign banks. So since the market is heavily dominated by the Government of India, it has become monopoly, and as a result, lack of competition result in lethargy. So there's hardly any innovation. And to be frank, those were the days where the entire banking service has been completely regulated by RBI. The deposit rates of interest, the saving rate of interest, RBI used to dictate. The lending rates of interest, what RBI used to dictate, whom to lend, whom not to lend, isn't it? Everything is been within the control of RBI. So that's how banking sector has been a complete monopoly those days by the Government of India. There's hardly any competition and hardly innovation. Though the government happened to go for nationalization of banks with an intention to convert class banking into mass banking in 1916, but the extent to which the banking services penetrated into the rural parts of India or the financial inclusion has been considerably less than compared to the current scenario. Post the liberalization, the financial inclusion and simply penetration of banking service interiors of India has been increased much better than compared. Of course, there was significant increase in banking penetration post nationalization, but that has been stagnated somewhere in the years of 70s and 80s. Okay, so one major problem that banks in good old days used to experience is lack of competition and completely regulated by the RBI. So imagine a situation, you have 10, 15 or 20 different types of banks owned by the same owned by government, and all banks do provide the same kind of saving rate of interest and provide similar kind of financial services. There are hardly any reason for one person to simply differentiate one bank from other bank, because no matter whichever bank you approach, everyone provides a similar kind of services and at the same rate of interest. They accepted the same rates. Their deposits, they pay the same rate of interest, and whenever they lend money, they happen to charge the same rate of interest, and henceforth there's been a lethargy and complete lack of competition within the banks has made these banks really redundant in this banking system. Now coming back, post liberalization, the very common problem that we started experiencing is one major reform that the banking sector experienced is deregulation of the interest rates. Post deregulation of interest rates, the very common problem the banking sector and the RBI right now experiencing is a problem related to monetary transmission. Monetary transmission. I hope you understand the literal meaning of the word transmission, like electricity transmission. When you place some power on the grid, that particular power happens to be distributed across the network. Similarly, if you look at these days, you might have been very thoroughly coming across this piece in newspaper that RBI happened to change the policy rate. And the very next day, you would also come across the newspaper that RBI changing policy rate. Let's say repo rate has been increased. So one common news you would be coming across is, if repo rate increases, how are the home loan rates are going to change? So many times you would come across this piece of news that home loan rates are going to increase, consumer loans are going to increase. How come a bank rate, simply a rate at which RBI lend money to the banks would have an effect upon the banks lending money to the markets? That is something we discussed as part of monetary policy. Because as of now, most of the banks have benchmarked with an external rate of interest, that is nothing but the policy rate of interest. This is what we call external benchmarking. So whenever the policy rate of interest in the market happens to change, these banks are also expected to change their base rate of interest, or basically the external benchmark rate of interest. Isn't it? Because when the cost of funds to the banks increases, then definitely the banks end up charging higher rate of interest to the customers. And this, in this process, so the change in the rate of interest at the RBI, and whether, at what level it would have a change in interest when it comes to the banks lending to the customers. And this is generally what we happen to call as monetary transmission. What is the problem related to monetary transmission? Now just imagine, the fact that in general, any market or any particular service provider or any particular seller of goods and services, based upon the volume of business, they would have the habit of simply differentiating customers into prime and subprime customers. Similarly, within banking system, we do also have this practice of segregating them into prime and subprime customers. Prime customers for the banks are those one who happen to simply provide them large number of who happen to be the big clients, like who deposits a larger sums of money, who happen to make a large amount of transactions, withdraw a large amount of money, happen to borrow and prompt in repaying within very prompt in repaying. So such customers are generally, let's say the industrial houses, Tata Group of Industries, or any such great big industrial houses. These generally referred as prime customers. Not only industrial houses, I mean to say, I just have given an example, but any such customer who happen to provide a large amount of business, large volume of business to the banks, they happen to be called a prime customers. And middle class people like you and me, generally the other customers, whoever happen to deposit a very small amount of money, and since our transaction base happens to be relatively small than compared to these people, or the volume of business provided by us is relatively much less compared to these people, we are categorized as subprime customers. Now just look at the scenario. In the absence of this practice of external benchmarking, just imagine if a bank, if RBI happened to tell the bankers, I would like to reduce the repo rate of interest, the rate at which I would lend money to the banks. And when these particular banks avail loans at cheaper rate of interest, do you really think that these banks would be interested in passing on cheaper rate of interest to both subprime customers and prime customers and par with each other? Definitely not. They always prefer to pass on the cheaper rate of interest to prime customers at the cost of subprime customers. And this was one of the very common problems since 1991. By the time since the time the re-regulation of interest rates, post liberalization, when the interest rates has been deregulated, liberalized. So when banks have been given the freedom to fix their own rates of interest. So the very common problem that the banks started simply, or the RBI started experiencing, is lack of proper transmission of monetary policy. These banks availing cheaper credit from the RBI used to offer these cheaper discounted rates of interest to these particular prime customers at the cost of subprime customers. Similarly, whenever the rate of interest, repo rate of interest increases or the policy rate increases, these banks, rather than passing on the burden to the prime customers, they used to simply pass on the burden, or they used to increase the rate of interest for the subprime customers, keeping the interest rates to the prime customers relatively low. And this is a very common problem, is what we happen to refer as monetary transmission. And how did RBI happen to overcome this problem? So this being the problem, the RBI has come with various alternatives and various solutions. So initially the banks have been asked to come up with a prime lending rate. Later we happen to move to a benchmark prime lending rate. Later the banks have been expected to come up with a base rate of interest. And then this base rate of interest, we have moved to marginal cost of lending rate, MCLR, very popular known as. So I'm just simply listing out from prime lending rate, from benchmark prime lending rate, we happen to move to base rate. So the banks were simply expected to provide a base rate below which, whenever the bank happens to make an announcement of a base rate, it does mean the banks are making it clear that they are not going to lend to any kind of customer below the base rate of interest that they happen to announce it. So later from base rate, we happen to move to MCLR, marginal cost of lending rate. And this, how is this marginal cost of lending rate calculated? Based upon internal benchmarking or external benchmarking. So as of now, if you know, most of the consumer loans has been fixed to the central benchmark. When I say external benchmark, this particular benchmark rate of interest, these banks do charge upon the loans of interest, depends upon the repo rate or the policy rate of interest. They need to anchor to the policy rate of interest. So that's how we happen to address to a larger extent the problem of monetary transmission. So that's the second major problem with respect to banking sector. Other than we have discussed prior to liberalization and post liberalization, one major problem remained happens to be monetary transmission. And one thing, though a Narasimhan committee has recommended to go for simply merger of banks long back, it has taken almost 20 years for the government of India. In fact, more than 20 years for the government of India to effectively implement his recommendations. There are certain other recommendations that I don't really think we would be able to discuss it now. But the other common problem significantly that the banks in India is experiencing is related to increasing non-performing assets. Increasing non-performing assets. So as such, in one of my previous class, I discussed about what is the difference between asset and the liability. So typically for what's an asset of a bank? The loans extended. And if these loans doesn't perform, does mean typically non-performing asset refers to the accounts of borrowers who doesn't repay the amount of money, either the principal or the simply interest rate within the due date. They are generally referred, or they are generally categorized non-performing assets. Typically in India, the practice is that the first 30 days of the default, banks categorize them into special mention account 0. From the day 1 to day 30. The accounts of these defaulters are categorized as special mentioned account 0, and then the next 30 days, day 30 to 31 to 60, they are categorized as special mentioned account 1, and 60 to 90 they are categorized as special mentioned account 2, and if the default period is for more than 90 days, they are generally categorized as non-performing assets. And these non-performing assets, again based upon the duration, are further classified into substandard, non-performing assets, doubtful, and loss making. So no matter, okay, at the end of the day, they are generally a non-performing assets of the banks, but it's based upon the duration. Okay, so if the period happens to be, the default period happens to be much more, then in general we end up categorizing as either substandard, doubtful, or loss making. Okay, so the reason why non-performing assets in India happens to increase, not only in India, across the country, this is a very across the globe, this is a very common problem. Like I've been telling you in one of my previous classes, that universal banking, I mean reserve banking is universal practice, and similarly bank across the world are expected to experience three different types of problems. One is the problem, one problem is credit risk. Credit risk is also what is referred as default risk, and then the market risk, exposure to the markets, isn't it? And the third one is happens to be the operational risk. The third one happens to be the operational risk. So these are the certain risks that the banks happens to experience across the globe, and that's the very basic purpose. I think most of you might have heard about these terms called Basel norms. Okay, Basel norms. So Basel is simply a place, okay, name of a place in Switzerland, where you have this banking for international settlements, wherein the central bankers across the globe happen to meet and come up and explore. I mean, in fact, they happen to explore various kinds of solutions to overcome the very common type of risk that banks across the world happens to experience. And it is as part of Basel norms, we would be discussing about this capital adequacy ratio or capital to risk weighted asset ratio. In general, what is the amount of capital that the banks need to maintain in order to overcome their in order to overcome their stress loans, or in order to overcome the problem they would be experiencing because of all these kind of risks. So when I take credit to risk asset ratio, capital to risk weighted asset ratio. So let's make it clear with respect to the term capital to risk weighted asset ratio. So what is an asset of a bank? Loans extended. So out of the loans, isn't it, not every loan extended to every type of customer happens to come with the same risk weightage, isn't it? So now lending money to governments would come with 0% risk weightage. Lending money to private sector enterprise, let's say imagine there is a 10% risk weightage. Okay, let's go for a 10% risk weightage. Let's assign a 10% risk weightage. Okay, and lending money to subprime customers, let's assign 20%. Imagine all of your funds, out of every 100 rupees, 50 rupees has been lent to government of India, and 20 rupees has been lent to entrepreneurs, and the rest of 30 rupees has been lent to subprime customers. Then you could simply able to figure it out. Since there is hardly any risk attached with lending money to the government of India, out of every 50 rupees, not a single penny is going to turn to become a balance. So your risk weighted asset here in this case would be absolutely zero. Your risk weighted assets were here in this case, as such, let's say you happen to lend 100 rupees, and out of which 50 rupees has been lent to government of India, where the default risk has supposed to be 0%, and you lend 20 rupees to the firms which has a 20% probability of a default, and then 30 rupees to the subprime customers, where 30% of the money is lent is going to turn to become non-performing asset. Then you would be able to calculate the risk weighted asset. So simply multiply the asset with the risk weightage. So you would be getting the total risk weighted assets. The proportion of money that you are, the capital that you are expected to maintain out of your total risk weighted assets is very commonly referred as capital to risk weighted asset ratio. So this is very something similar to the practice of provisioning. Provisioning is simply the practice of keeping a certain amount of money aside from your earnings or from the investors pocket in order to overcome some unforeseen circumstances or just to meet the rainy day. Similarly, the banks are expected to meet certain amount of money to overcome this particular in general, to address the various common problems they would be experiencing. That's the very basic purpose of Basel norms. I hope you understand the meaning of the word capital to risk weighted asset ratio, and we have seen how to calculate it. And going ahead with what's exactly is the reason why in the modern days the non-performing assets of banks in India is experiencing very high rise is simple. Why do NPS rise? One major reason could be the very high rate of interest. When the rates of interest happens to be high, so when the cost of capital is high, it would be very difficult for the investors simply to generate returns on par with the amount of money they happen to raise. Let's say if I borrow money at 20% rate of interest and invest in a business, no matter whatever my business does, unless it pays me more than 20% returns, I cannot afford to repay my loan. So one major reason why the NPS in India happens to be enormously high is because the cost of capital in India is relatively high than compared to most of the countries. So when the interest rate goes up, there is a chances that the NPS, the most of the loans tend to become non-performing. The second is the cyclical phases of the economy. Okay, you know the fact that sometimes the boom cycle, okay, and then you have these bust cycles, isn't it? So like we have as of now, there is a global recession. I mean, there is an onset of global recession waiting, isn't it? So when you have the economy contracting, and obviously there might be many enterprises which might go out of business and they would not be able to promptly repay the loans. That could be the other reason. The third is simply the bad choice of investments. Okay, so if people might be thinking everything going good, okay, they might be having certain kind of expectations, and if the market doesn't result in such kind of results, isn't it? So definitely a bad choice of investments, bad way of operating your company. There could be any number of reasons why a loan might turn to become a bad asset. And every person whoever defaults upon this particular loans borrowed from bank is not again categorized as a bad person. So if I simply ask you a question, is every defaulter a bad person? Not necessary. Okay, those people who ever happen to have an ability to repay, but they doesn't repay, or simply borrow money with a certain pretext and ends up diverting money for certain other purpose, in such case they are generally referred as a willful defaulter. So it is only the willful defaulters that are generally blamed. Okay, that are generally the one who are said to be referred as those people who end up simply creating this problem related to banking sector. So there's no point in listing those people. But okay, so not every defaulter. Let's say a farmer who happened to raise money for or who availed a crop loan, he would not be he would not be in a position to promptly repay the money because of the crop failure or simply because of the monsoon failure, isn't it? So in such case, not every defaulter can be categorized as a bad person. So that's the reason I have explained who is said to be generally categorized as a willful defaulter. So now the question is, when there are banks in India is experiencing an increasing NPAs, how to address these problems? Generally, the very common way of recovery of the loans is, the fact the loans are again categorized into secured and non-secured loans. So when it comes to secured loans, these loans are backed by assets. And what is the very common practice of these banks recovering them? By simply selling these assets in the market. Most of you might have come across the advertisements in the newspaper. The banks simply says these are the gold loans that are being put to auction, isn't it? So this practice is what we generally refer as foreclosure. So banks, what do they typically do? They just go for a practice of foreclosure. They take over the assets whichever has been used as a collateral and simply sell these assets in the market for the sake of recovery. Later, you might be aware of the 𝗧𝗪𝗺 Act, isn't it? So 𝗧𝗪𝗺 Act, this is something I expect you to go through. 𝗧𝗪𝗺 Act of 2002, which helped the banks, made it relatively easy for the banks to go for recovery. And the other initiatives taken by the bank in the recent past is the RBI encouraging banks to set up a joint lender forum. Then we also have initiatives like strategic debt restructuring. We also have initiatives something like strategic debt restructuring, SDR. And then we have S4A, scheme for sustainable structuring of stressed assets. S4A, very popularly known as S4A. And you might also be aware of the fact, the concept of bad banks. So bad bank, or simply as such, we could refer this bad bank as one such big institution, what is generally referred as asset reconstruction company. So what does simply an asset reconstruction company does? Okay. So the proposed bad bank is simply one asset reconstruction company that's going to be owned by Government of India, which is going to purchase all bad loans from the market and is going to take the responsibility recovery. So typically an asset reconstruction company is something like a loan recovery agents. They simply purchase all the bad assets or bad loans from the banks and they happen to take their initiative of recovery. And these are what we generally refer as asset reconstruction companies. So the government has taken various initiatives, and at the same time, I just want you to go through the recent initiatives with respect to Insolvency Bankruptcy Code of 2016 and the FRDA bill, Financial Resolution Deposit Insurance Bill. Okay, of course, it has never been materialized. When it comes to 2017, FRDA bill has never been materialized. But I just expect you to go through IBC, one great initiative by the Government of India to help this address the problems of insolvency bankruptcy in this country. And and at the same time, just also refer the other aspect, that is the twin balance sheet problem that the banking sector, what exactly is the twin balance sheet problem in India. So let's try to conclude this particular session on money and banking with certain important recommendation that is required, or certain committees that have been set up by the government to address the problems related to banking sector and make certain important recommendations related to banking sector. The first one is something related to both the financial sector and banking sector, that is Narasimha 1 and 2 committee recommendations. This is one at most important. And the second committee that you need to go through is Damodaran committee recommendations, related to improving banking services in the markets. And the third is the 𝗪𝗪𝗧 committee recommendations, 𝗪𝗪𝗧 committee recommendations with related to financial inclusion. And then the recent recommendations the issues related in the 𝗧𝗦𝗔𝗧. So don't get confused with their health related. So you have certain 7 important recommendations as part of Mission 𝗧𝗦𝗔𝗧 with respect to reforming governance in banking, public sector banks mostly. So it is under this context you might be coming across this word called Bank Board Bureau. So there have been a lot of questions asked with respect to Banks Board Bureau, who determines the rate of interest, who appoints the heads of banks in India. So these are certain important committee recommendations that I would expect you to go through, along with Urjit Patel Committee recommendations on monetary sector reforms. Urjit Patel Committee recommendations on monetary sector reforms. So it is better to simply go through reforms of all these committees so that you would be having a fair idea of what exactly is the major changes that are going to become government is going to initiate, and what are the problems related to banking sector, and what the problems has been addressed by these particular committees. So we have discussed about briefly about money, the different types of banks, the problems banking sector experiences, and various committees related to address the problems related to banking sector. Thank you.